August 2023, question 5 boy. Acha tuone iko na nini. Hope you're all there. August 23, 5 boy. Now, we are told that Mapato Limited has the following capital structure, which it considers optimal. Very important, the capital structure must be considered optimal under Wmcc. Remember what we said, the marginal weights that we use are the weights determined directly from the optimal capital structure. So the capital structure must be optimal. What is the essence of it being optimal? Unazichukua vile ziko. In the optimal capital structure, debentures are 25%, preference share capital is 15%, ordinary share capital is 60%, right? Then we are told, Mapato Limited's expected profit after tax for the year ended 30th June 2023 was 34,285,714. Hiyo ni part yao. Mapato has an established dividend payout ratio of 30%. So imekuwa inalipa 30% kama dividends, meaning ina retain ngapi? The 70%. The tax rate for the company is 30%, and investors expect earnings and dividends to grow at a constant rate of 9% per annum in the future. So we have our G, 9%. The company paid a dividend of 3.6 per share in the year ended 30th June 2023. The company paid DO Amadi 1. DO, DO, thank you. Per share in the year 2023, the company shares currently sells at 60 shillings per share. That should be our DO, right? The company can obtain new capital as follows. Ordinary shares. New ordinary share capital can be issued at a flotation cost of 10%, where we have the flotation cost, KE of retained earnings will be different from KE of ordinary shares. Remember that concept, courtesy of the flotation costs. Preference share capital, new preference shares capital can be issued to the public at 100 per share. The flotation cost is 5 shillings per share and a dividend of 11 shillings per share. Debentures can be issued at an interest rate of 12% per annum. Assume that the cost of capital is constant beyond the retained earnings breakpoints. Mapato Limited has the following investment opportunities. Hiyo achana nazo kwanza. Let's first of all, maybe to analyze note number 4. Note number 4, examiner angeamua kutunyima. Still okay. Angetaka tujijazie. Because this component called equity has two sources. From the profit after tax, I'm paying out 30%, I'm retaining 70%, right? So whatever I'm retaining is the retained earnings. That is a component of equity. Other than the retained earnings, the ordinary shares can also be issued at a flotation cost of 10%. So meaning from equity, I have two sources, retained earnings and ordinary shares. When I look at the optimal capital structure, weight of equity ni moja peke yake, which is 60%. Wameita ordinary shares, but that is equity. So I have two components, but I have one weight, meaning I must use one factor at a time. I must use one component at a time. I must exhaust the retained earnings available before I go to the ordinary shares. So exhausting the retained earnings available, we are going to explain about note number 4. The cost of capital is constant beyond the retained earnings breakpoint. And that's why in required number 1 on Atuliza, calculate the breakpoint in the marginal cost of capital schedule. Not so difficult. The parameter formula breakpoints. Breakpoint equals to, remember the amount available? We divide by what? Amount available, we divide by weight. Then from the retained earnings, from the retained earnings, from the retained earnings, how much we expect? Can we say 70% of that? 34 to 85 ngapi? 714. How much is the retained earnings available? $2.4 million. I'm at 24 million. So you can say 24 million. So that means in 2023, I'm going to have retained earnings valued at 24 million. So therefore, my breakpoint, so retained earnings breakpoint, retained earnings breakpoint becomes the amount available of 24 million divided by the weight of equity available 0.06. So how much is the breakpoint? 40. So you're having shillings 40 million. Now, what does the 40 million stand for? What does the 40 million represent? The 40 million basically appreciates kuwa inatuambia kuwa as long as I'm raising any amount from 1 shilling up to 40 million. Remember, even if I'm raising 1 shilling of the total amount, 60% must come from equity, 25% must come from debt, 15% must come from preference shares as per the optimal capital structure. So out of this amount, the baby class tuliimba hii wimbo ikaingia kimpango ikakataa, lakini tukatoboa. So hapa iko itaingia na tutakuwa na kimaliza mtihani tunaidebate, sio? Unless I'm expecting a competitor. Anyway, as long as I'm raising any amount, 60% must come from equity, the optimal capital structure, right? So 60% must be equity. 25% must be debt, and 15% must be the preference shares. So if I'm raising 40 million, what is 60% of 40 million? Are you getting out 24 million? Now, anything below 40 million, like what is the 60% of 39 million? $23 point something, right? So my question is, if 60% of 39 million is 23 point something million, am I able to get that 23 point whatever million from the retained earnings available? The retained earnings can give me up to how much? Retained earnings can give me up to 24 million. You see that? So as long as I'm raising any amount that has not exceeded 40 million, the 60% of it that should come from equity will be coming from the retained earnings. As long as the amount that I'm raising agenda beyond my breakpoint, that part that represents equity will not be coming from the ordinary shares, will now be coming from the retained earnings. So, what if I exceed 40? Let me assume now I want to raise, let's say 42 million. What is the 0.6 that should come from equity? 20, 25. 25.2. So 25.2. Are you seeing a problem there with equity? So meaning I've gone beyond my retained earnings. So out of 25.2 nitasema hapa kuna shida. Niko na retained earnings ambayo itanipea 24. The remaining 1.2 million must now come from the ordinary shares. And I'm very certain the 1.2 million is the 60% of the extra 2 million. Second, above 40 na 2 million. If I do 60% of 2 million, I'm very certain I'll get 1.2. 6 times 3 squared. So breakpoint kwa ufupi inatuambia the maximum amount that I'll be raising while using retained earnings as my equity. The retained earnings breakpoint, the total amount that I'll be raising where equity will be represented by my retained earnings. So when will I stop using the retained earnings as my equity? I'll stop using retained earnings as my equity when I exceed the breakpoint, when I exceed the 40 million. Right together. Haya, tuendelee na swali tuone. Tutafanya swali lingine. Never don't overthink. Last, nikikataa kuingia itaingia kwa the second question. Silazimishe sana. Haya. Can we get the cost of each capital structure component? So they want us to get the component cost. They want us to get the component cost. So in the component costs, can we start with KE of retained earnings? The formula is P what? PO into 1 plus G divided by what? PO plus what? PO plus G. PO ametuambia ni ngapi? Not number 2, ndio. So 3.6 growing at what rate somebody? By saying 9%. Can I say 1.09? 1 plus 0.09, right? What is the market price per share? I think 60 plus 0.09. What is our KE? How much? 16%. I have overheard something like that. 15.5. 1554. That is 15.54%. Then we have KE of ordinary shares. Which is PO into 1 plus G over PO minus what? Minus M. So our kila kitu tuko nacho hapo ni 3.6 into 1.09 over the market price of 60. Flotation cost walisema ni ngapi note number 3? It's always 10% of the market price. So 10% of 60 plus 0.09. What is our KE? How much? 0.1627. That is 16.27%. So this is what we are saying. Before niende kwa ordinary shares ambazo ziko expensive, lazima kwanza ni exhaust zile retained earnings niko nazo. So when will I exhaust the retained earnings? I'll exhaust the retained earnings when I raise up to a total of 40 million. That's how. Because I cannot choose an expensive source if I still have a cheaper source, if I still have amount from a cheaper source. I exhaust amount available from a cheaper source before I can utilize anything from a more expensive source. And that is what is explained by the concept of the breakpoint. When do I stop? When do I end? When do I stop using a cheaper source? When I reach its breakpoint. So, can we have KP? KP equals to? Nakumbuka formula? Preference dividends divided by what? The market value will have the flotation cost, right? We have the dividends. Note number 3, when compare preference dividends is unhappy. I think 11. And the market price of how much? And the icing 100. The flotation cost yangapi? Yeah, 5 shillings. So make it a percentage. What is 11 over 95 times 100? Yes, 11.58%. KD nayo. The information given about the debt, note number 4, note number 3, which the debentures can be issued at an interest rate of 12%. No information about the market value, no information about only consumption, the debentures will be issued at par. So KD becomes 12, then we adjust forward. Tax rate management is already 30%. Yes, again. So 12 times 0.7. 8.4. 8.4. So that gives us the 4 marks. Then the next 4 marks you're being told, calculate the weighted average cost of capital in the intervals between the breakpoints in the marginal cost of capital schedule. No problem. So tunamwambia kwa WMCC it should be the weighted marginal, not weighted average. Confusion the examiner, but it's okay. Don't look at weighted average, but we work with it as weighted marginal. So the WMCC formula ni ile ile plus WDKD plus WPK KB. Then tunaanza na ku appreciate kuwa WMCC of raising up to how much? Breakpoint yetu ya retained earnings ilikuwa 40 million. So raising up to 40 million. We have the weight of equity of 0.6. Equity, am I using retained earnings or ordinary share? I'm using I'm using the retained earnings, right? Whose cost is 15 points, so 15.54. As long as they exceed the breakpoint, equity is coming from the retained earnings. What's up? What's up? Hi. The weight of debt is what percent? So 0.25. KD niko tu na moja, 8.4. Right? The weight of preference shares is 0.15. KP pia niko na moja, 11 point what? 11.58. So can I have my WMCC? Points. So 13.161%. Then you don't stop there. We have WMCC of raising above that. Raising above 40 million now. When I go beyond 40 million, when to use the retained earnings, I no longer have the retained earnings. So now my KE doesn't manipulate. So the weight of equity is 0.6 KE. Am supposed to change it? Retained earnings nilishamalizana nazo kwa sababu nimepita breakpoint yake, ndio. Anything above 40 million, now equity is coming from the ordinary share. Whose cost is that? 16.27. That's the difference. Debt ni moja tu, sina options. Na preference shares pia ni moja tu, sina options. What is the WMCC? $13.60. That gives us the 4 marks. Now let's work with the last 4 marks now. The last 4 marks. Marks ya mwisho tuiangalie. Tunaambiwa using the marginal cost of capital schedule, identify the projects that the company should accept and why. So just write for me MCC schedule. So it's called Investment Opportunity Schedule, IOS, ama MCC schedule. Investment Opportunity Schedule, ama marginal cost of capital schedule. Then we can say it is a graph. It is a graph that compares. It is a graph that compares the IRR. The IRR, remember IRR in full? Internal rate of return, right? So the IRR with the MCC of the projects. It's a graph that compares the IRR with MCC of the projects for decision making. For decision making. Full stop, then you say projects whose IRR projects whose IRR is higher than the MCC. Projects whose IRR is higher than the MCC are accepted. Remember, IRR is the return. Return is like the income. MCC is the cost. So when the return is above the cost, that project is viable. Cost ikiendajia return, it's giving me loss. Because now that project has a higher cost compared to the return. We need the return to be above the MCC. Continue by saying this. Optimal capital budget. Optimal capital budget is the total amount required. The total amount required to undertake accepted projects. The total amount required to undertake accepted projects. I.e., where IRR and MCC, where IRR and MCC intersect, where IRR and MCC intersect. The next point, Sema, the first step is to rank the projects. The first step is to rank the projects using IRR. The first step is to rank the projects using IRR, i.e., the higher the better. The higher the better. So let's go back to the question. So note number 5. Note number 5. We're told that Mapato Limited has the following investment opportunities. So you have the project, the cost, and the IRR. So let's start from there. We rank the projects using the IRR. So we have the project. We have the initial outlay, which is the cost, the IRR, then we shall run. So project A is in millions. So A requires 10 million with an IRR of 17.4, right? Project B nataka 20. Na IRR yake 16.0. Project C inataka 10 with an IRR of 14.2. D needs how much? 20 with an IRR of 13.7. Finally, E needs 10 with an IRR of 12.0. How much is the total that is needed? Is it 30, 40, 670? So we need a total of 70 million. Now let's have the schedule now, MCC schedule. Let's have the MCC schedule. This is simply a graph. This is simply a graph. So on this side, we have IRR from MCC as a percentage. And this other side, we have the amount. Amount, you can express it in millions. Now, in getting the scale, hizi ndio zile vitu zinafanyanga una threaten your competitor. Anaona unatumia graph paper na shanga utaidoing with the graph paper. Kwani swali gani ilikuja graph? You confuse the enemy, the competitor, not the enemy. Anyway, now, getting the scale. Tukianza na hizi za chini, the total amount that we need to capture in our graph is 20 million. So 70 million we divide by 10, at least boxes kwa nasema karibiane na 10. Hiyo ndio sheria ya graph. Isikuwe ndogo sana. So we can do 10-10. Those will be 7 boxes, not small, not bad, sio mbaya sana. So you have 10, 20, 30, 40, 50, 60, and 70. Then on the other side, the highest MCC is 13.6. The highest IRR by the hatukurang. Let's measure kurang kwanza. The higher the better. In number 1. In number 2. In number 3. In number 4 and in number 5. Coincidentally zimejiranga. Sawa. Sisi kawaida zitakuwa zimejiranga. That's why it's important to confirm. So the highest IRR is 7. So you need to accommodate 17. 17, can we go into 2? 2 will need 8 boxes. That will need 9. So that we reach 18. It's okay. So we have 2, 4, 6, 8, 10, 12, 14, 16, so I have 18. Great. So let's now plot it. Let's plot the graph. We start by plotting the IRR. Based on our ranking, the first project for consideration is A. A is given priority still. So you take project A, it needs how much? So A needs 10 million with an IRR of 17.4, right? So after page 17.4, nijia katikati kidogo. So 17.4. So join the two. Created line. And you call that one project A. After A, I go to the next best. The next best is B. Forward ever, backwards never. Forward ever, backwards never. Nisha spend 10 million, B inataka 20. Cumulatively nitafika ngapi? So B itanifikisha hapa 30. Forward ever, backwards never. With an IRR of 16, ndio. So usianzie hapa, unatafuta penye 16 iko somewhere here. So you again do the disjointed line. You have it there, you call it project B. After B, do I go to C? Right? C needs ngapi? C needs 10. Will 10 reach me 40? With an IRR of ngapi? 14.2. So 14.2, here 14.2 together. So somewhere there. So this is project C. After C, do I go to D? D nataka ngapi? Nataka 20, ndio. 20 isha ngapi? 60. With an IRR of 13.7. So 13.7 hapa juu karibu na 40, somewhere there. Then I go project D. And finally, after D, I go to where? Nenda kwa E. E nataka 10. 10 itaisha kwa 70. Ndio. Na IRR yake ya ngapi? I think 12%. So 12% iko hapa chini. So this one is E. Angalia kama ni bado fanya kitu that makes sense. Atumwachie Mungu. Atumwachie Mungu kumsaidia. Then as you conclude, sasa join hiyo line ya nje. So you join this. You drop up with the ruler. Hiyo unaita IRR. Can you explain this now? Let's go to MCC. So MCC is equal to mbili. MCC ya kwanza ilikuwa ya raise mpaka ngapi? Ya raise mpaka 40. So raising up to 40, from 0 to 40, cost yake ni 13.16. Clear. Now be very careful because in finance, we only plot. We don't draw the correct graphs. Hapa tufanye mambo ya nini? Statistics. Hapa ni finance. So the chances plotting yako inaweza kuwa na errors, but just be keen. We are at 40%, 40 million. So meaning, raising up to 40 million, the cost is 13.16. So be keen with it. What was the IRR of project C? 14.2. So 14.2 na 13.1, lazima ikuje chini ya 14.2. Right? What was the IRR of D? 13.7, sindio? Na hii ni 13.1. So inamaanisha kuwa inafaa ikuwe chini ya hii line pia. Because hapa si 13.7 and our cost is 13.16. So meaning ukichora this is 40 yeka chini ya hiyo. Then you just do a straight line. So 13.1. You can use a different pen. Or the pen with a different color. You want pens, these are blue. Popular said use a different pen unabadilisha blue na blue. So you simply do a straight line. So raising from 0 shillings up to 40 million, the cost is constant at 13.16. just a straight line. Raising above, we're together up there. Raising above 40 million, the cost is 30. Raising above 40 million, the cost is 13.6. Just be careful. IRR ya D ni ngapi? IRR ya D ni 13.7. Si 13.6 iko chini ya 13.7. So lazima pia itembelee hapa chini. Ondoka karibu namba chini. So you increase it a little bit, then chezea hapo chini. And you call that one. Yeah. Call that one Wmcc. So project A, is it viable? Return yake iko huku, cost yake iko chini. Am I making a profit? But project A, right? I'm making a profit. Project B, I'm still making a profit. The return is higher than the cost. Sindio? Hii hapa juu the profit. Project C, am I still making a profit? What of D? I'm still making a profit. Hata kama ni kadogo ni profit. Sindio? So return ni 3.7. 13.7. The cost is 13.6. What of E? E now I'm making a loss, right? Because sasa return imekuja chini ya cost. Sasa, so can you appreciate kuwa projects A, B, C, and D? Projects A, B, C, and D. Jatuona wataka English gani? Should be accepted. Wataka to advise, identify the projects that the company should accept and why. So projects A, B, C, and D should be accepted. Since their IRR is above the MCC. Since their IRR is above the MCC. And maybe you can say, hapo tu chini, although it was not asked, what is our optimal capital budget? How much do I need to invest in the projects accepted? Are you saying 60? By the way, this point, hapa, this is our optimal point. Just say optimal capital budget equals shilling 60 million. Optimal capital budget equals shillings 60 million. So you can say at this point is the total amount that I need to invest in the projects I've accepted. Let me check for you September 2021. Question 4B, page 34. September 2021, question 4. 2021 forward. I think we can chambua it together. September 2021 forward. Let's see what it has. We are told that Dinosoft Limited's capital structure, which it considers optimal. That word optimal is very key for MCC. Hiyo ndio jina unafaa uitafute pia. Ukiona ijaandikwa mahali, then wameuliza MCC, anza kuprepare for 3 months. Anza kuprepare for 3 months. So capital structure, which it considers optimal, is given as follows. Debenture capital, we have the reserves, ordinary share capital, and the preferred share capital. So this time, when you put the percentage, when you put the weights, or you put the amount, no problem, you can still get the weights. The firm's historical earnings per share and the dividend per share over the last 5 years are given as follows. So from the years to December 31st, 2016 back at 2020. Can that information help us get the G? Kiona kitu kama kwanza kuprepare calculate G. Na formula ya G si unakumbuka? Hayo unakumbuka. The company's ordinary shares currently sell at 50 shillings per share, and the Securities Exchange new ordinary shares will be sold at this price. No problem. That is our PO. The company's expected net income for the year ending 31st December 2020 is 40 million. So 2020 is like our current, right? So meaning, zile dividends to nazo za 2020 zitakuwa DO. Nakumbuka tulisema kuwa it is always DO unless otherwise stated. Wakuambia tu dividends bila ku-identify kama ni expected ama current, it is always DO. We always report what has happened unless otherwise stated. That's how. So we expect earnings, we expect the income, net income of 40 million. And Dinosoft Limited adopts a constant payout ratio of 40% as its dividend policy. You're paying out 40%, you're retaining. So can you help us here the expected retained earnings? There's some retained earnings we expect, right? 60% of 40 million. The company can raise additional capital as follows to finance acceptable investment projects, equity, utilize all available retained earnings. For the year 2020, any extra external equity will be raised through issue of new ordinary shares at a flotation cost of 10% of the issue price. Preference shares, new preference shares will be issued at 11 coupon rate. The par value of each share is 100. New preference shares will be issued at par, subject to a flotation cost of 5 shillings. New debentures can be sold at a coupon rate of 13%. The debentures will be issued at par. Calculate the breakpoint in the marginal cost of capital schedule. Breakpoints. We still have a source that a component that has more than one source. But it's for now about equity. From equity, we have the retained earnings, and we have what? The ordinary shares. The only touch in this question that maybe if I engage a rush out weighing the weight. I'm very sure nikifanya weight, mimi nakuaminia. So tuko na source, tuko na amount, so that we can have the weight. The figures are in millions. So source ya kwanza tuko na debenture, can call it debt. What is the amount from the debt in the optimal capital structure? You use it as it is in the optimal capital structure. We have another source called equity. How much do you expect from equity? How much? Are you saying 60? Hiyo tu ndio kulikuwa na catch. Mbia neighbor, equity ni reserves na ordinary shares. Usitafute mbali. Hata kama debentures zingekuwa mbili, labda tuko na debentures na debt, tuna combine. So from equity, we are taking 15 plus 45. Do you have the preference shares? That is also 15. Total comes to 100. So the weight of debt is 0.25, weight of equity 0.6, weight of preference share 0.15. Hii inafanana na hizo nyingine hivi. How much is the expected retained earnings? 60% of that. With 60% of 40 million. We are paying out 40%, we are retaining 60%. This looks like 36. Sorry, 24. 24 million. Right? Kwa hivyo, what is our retained earnings breakpoint? Vizuri kuandika formula, amount available divided by what? Divided by the weight. The amount is 24 million. The weight of equity is 0.6. Are you going back to 40 million? Coincidentally, our weight is 0.6 here. That is our breakpoint. Then we are being asked to get the weighted marginal cost of capital in each of the intervals between the breakpoints. KE. KE retained earnings. We start with the DO. 1 plus G over what? The PO plus G, right? The only unique thing here, Sasa, is calculate nini. Use the N root. What is our N? 5 years. Or 5 minus 1. 5 minus 1, right? So our N is 4. What is the most current dividend? 3.6, thank you. Ya kitambo kabisa. I think 3.0 minus 1. What is our G? Zero point. That is 0.0466. I can make it, use it as a decimal. Kama hiyo. Sasa mimi nimemaliza kila kitu. Sasa niwe kumalizia. If I may ask, ona tumepewa EPS. Is it relevant? Is it material? Is it relevant? The EPS is there just to make somebody pay when others pass. Yeah. KE equals to unaanza na kucheza na formula. Has accepted. Yes. Yeah, it must accept. Is there? People in Gapi, saidia neighbor. Note number 2. Wait. So you get the KE of retained earnings of Gapi? 12.20. 12.20. Is it? But we have ordinary shares. We don't celebrate so much. We can have ordinary shares. So K of retained earnings was 12 it's selling at par, so don't even need the interest. So retained earnings 12.13, ordinary shares 13.03, KB 11.58, KD 9.1, right? The debt is selling at par. It's on 8.5. Then simply take your interest rate and just put I think 0.7, right? That is the 9.1. Great. So WMCC. So raising up to 40 million. The only difference is in equity. Equity will come from the retained earnings. The difference is in the retained earnings and ordinary share. So hapo ungepeana title WMCC of raising up to 40 million. Hapa chini yake. Hapa chini yake baada ya comment. So hapa WMCC of raising up to 40 million. So they are raising up to 40 million. The KE comes from the retained earnings, right? And that's why our KE will be 12 points. 12.13. Equity is coming from the retained earnings. So weight of equity is happy. That's okay. And the next. WMCC of raising above 40 million. The share allocated for 5. Okay, so when you are raising, so the WMCC is WK plus WDKD plus WPKD. Kumbuka equity tuko na KE mbili. Kuna KE ya retained earnings, kuna KE ya ordinary share. Hizi tumia zote kwa pamoja. Ndio. Lazima nitumie retained earnings, nimalizane nazo, ndio niende kwa ordinary shares. So when will I be using the retained earnings? When I'm raising up to how much? When I'm raising up to the break point of the retained earnings available on that, 40 million. See that? The weight of equity is 0.6. KE, ile ya retained earnings ndio tunatumia. Na KE ya retained earnings nilipata ngapi? 12.13. 1 something depending na 12 points. Let us see 13. 12.26, 20, and 12.2. Then the weight of debt is 0.25. Pages to go to Namoja, which is 9.1. Alafu weight of preference share 0.15 KP nayo 8 points. 11 points. 11.58. Hiyo nitapata. Right? Then I have WMCC of raising above shillings ngapi? Raising above 40 million. Where the weight of equity is still 0.6, but KE has to change. The retained earnings are normal. So I have to use ordinary shares. So cost was 13 points. 13.03. Debt is 0.25 KD, you remain at 9.1. Preference share 0.15 KD is 11.58. Then kind of kumaliza nichore the MCC. Now there is a question in May 2017, question 1B. May 2017, question 1B. Kindly, can you just go there for 5 minutes? Because nataka tumalize story leo Thursday tuanze capital structure theory. May 2017 one call, page 74. Great. May 2017 one call, page 74. Kenzel Limited, we are there. So we are told that Kenzel Limited has the following capital structure, which it considers optimal under both the present and forecasted conditions. Everything is about optimal. We have the long-term debt is 45%, equity is 55%. Page 77, May 2017. May 2017 one board. May 2017 one board. When you look at that capital structure, hakuna preference shares. Sindio? Na vile hakuna preference shares, hakuna mahali tutaulizwa KP. Because the funds must be obtained based on the optimal capital structure. What is available in the optimal capital structure is where the funds will come from. In the optimal capital structure, you have the long-term debt and we have equity. So money will come from debt and equity. We can have different debts. Start after the breakpoints. We can have different equity. Start after the breakpoint. So in this, I'm bringing for this question so that we don't just think that breakpoint itakuwa kwa retained earnings peke yake. Hapana. Hii swali iko na breakpoints for debt. So let's see. So you have 45% of the long-term debt and 55% for equity. That gives us the total of 100%. The management of Kenzel forecasts the after-tax earnings for the forthcoming year at 2.5 million. So na forecast for profit loss for 2.5 million. The company has been paying 60% of its earnings as dividends, and this payment ratio is expected to continue into the foreseeable future. So we are paying out 60%, we shall retain. So retained earnings will be 40%, right? The company's present loan commitment will allow it to incur additional leverage according to the schedule presented below. So 0 to 500,000, 9% debt. 500,000, 900,000, 11% debt. And 900,000 and above, 13% debt. So tuko na debt tatu. Na kama tuko na debt tatu, lazima nizitumie in bits. Nimalizane na ya kwanza, niende kwa the next. Nimalize ndo niende kwa hiyo nyingine. I utilize what is available from a cheaper source before I can go to an expensive source. From our analysis, 9% ni cheaper than 11%. Sindio? Na 11% ni cheaper than 13%. The tax rate is 30%. The current market price of equity shares of the company is 22. The last dividend on equity share was paid at 2.2. D1. The last dividend paid is it D.O.? D.O. And the expected growth rate is 5%. New equity shares can be sold at a flotation cost of 10% of the issue price. Kenzel has the following investment opportunities for the coming year. Tuko na project A, B, C, D, and E. Project A tuko na cash outlay, tuko na annual net cash flow, tuko na project life. Na IRR huko amepewa question mark. Wow, life is difficult here. So question mark for A, question mark for D, for C. The amount in shillings at which breaks in the marginal cost of capital schedule occur. So hapo ni breakpoints tena. And we know that breakpoint equals to breakpoint with the amount available divided by what? Amount available divided by the weight. So I can start with the retained earnings. How much of the retained earnings do you expect? With 40% of 2.5. Which is nothing. $1 million. For if your the retained earnings breakpoint amount available of 1 million divided by the weight of equity 0.55. How much is our breakpoint there? Don't be afraid of the calculator. No, it's not syntax error. How much? 1.82. 1.82 million. So after the 1.82 million of the retained earnings, next equity will come from the ordinary shares. Ordinary shares, they are unlimited. Then we go to ya pili, kuna debt. Na debt ya kwanza tunaanza na 9% debt. 9% debt, we can raise up to how much from the 9% debt? I think 500,000. Kwa hivyo breakpoint yake ikuwe ngapi? Amount available of 500,000. Weight of debt is 0.45. Which gives us how much? 1.11. Na tuko na debt ingine ambayo iko na limit. We also have another debt that has a limit. Ambayo ni is it 11% debt? So 11% debt cumulatively that's ngapi? And by then be very careful. Examiner alikuwa na option ya kwa hiyo story ya debt. Alikuwa na option ya kusema story kama hii. Aseme 9% debt. From 9% debt you can raise 500,000. From 11% debt we can raise 400,000. It is the same story. Whatever backwards never. Sasa 9% ishanipa 500,000. I don't go back to zero. Already nimepata 500 from one of the debt that is cheaper, right? When I got the next available debt, it is cumulative. It's a top up. It's a top up. Sasa, fortunately, kwa hili swali examiner alikuwa generous. So you could pass it without knowing. Lakini examiner anaweza amua separate aseme 9% debt itanipa 500,000. That is the case here. 11% debt inipe 400,000. It is still the case here. So it's upon you to appreciate poor. After dealing with the 9% debt, I don't go back to zero. I already have 500,000 from debt. Any additional debt that comes in continues from where I stopped. So the total amount that will come from the 11% debt will be the cumulative figure about 900K. I'm just clarifying on that so that wakileta vingine next time ama kwa exam yetu isitupate unaware. So here, can we have this breakpoint? Amount available of 900,000 divided by debt, weight is 0.45. That is 2M. 2M. That is our 3 marks. Then they want us to get the Wmcc at each of the intervals between the breaks. We have KE. So, get for me KE of retained earnings. You get KE of ordinary shares. You also get KD, your 9%. You get KD 11%, and you also get KD of 13%. Your 13% haina breakpoint because it is above 900,000. So now you go unlimited. There's 900 and above still. So we can raise any amount that we need over the 900,000. That's why it doesn't have the breakpoint. The interpretation is similar to ordinary shares. So any equity above the 1 million will come from the ordinary shares, unlimited.